So we're seeing some pretty big moves happening in the markets right now, and a lot of it seems to be tied to these concerns about tariffs. Yeah, there's a lot of anxiety out there, and it's definitely showing up in the way global equity markets are behaving. We've actually got some sources suggesting a beatening decline. And one of the things that really caught my eye was a statement from the head of global currency and fixed income strategy over at Russell Investments. They're saying that the market is straight up in a panic mode right now. And just to give you an idea of how seriously people are taking this, their investor risk aversion gauge, which takes into account both pricing trends and those broader sentiment indicators, is getting close to levels that we haven't seen since September and October of 2022. That's when we saw those huge interest rate hikes by global central banks. So it's pretty significant. One of the things we're seeing that really underscores this concern is what's happening in the VIX Volatility Index. I mean, everyone on Wall Street watches this thing. It's often called the fear gauge, and no, for good reason. Just on Monday, it spiked all the way up to 60. Now, to give you some context, that's the highest it's been since that global market sell-off back in August. And what's even more interesting is that the VIX had already closed above 45 on the Friday before. That was actually the first time it had done that since the whole COVID-19 crisis back in 2020. And not only that, that Friday also saw the biggest single-day increase since that same crisis period. And we even saw the VIX climb above 60 during intraday trading on Monday. Now, the way to think about the VIX is it basically measures how much volatility investors are expecting in the stock market, kind of looking ahead over the next month. And so a higher number obviously needs to bear anticipated more choppiness. To give you an idea, over the past decade, the average has been a little over 19. So when you see a reading of 60, well, that's something that's gained your attention. And this isn't just something happening in the US. Over in Europe, a similar index, the Euro STOXX Volatility Index, was actually expected to see a bit of single-day increase. I'm talking in absolute terms since October 2008. And if that date sounds familiar, well, that was right smack in the middle of the global financial crisis. So what we're seeing is these two major volatility indicators, one in the US, one in Europe, both flashing red. It's like having two different letter veins, both pointing towards a storm brewing on the horizon. And speaking of signs, another thing we're watching closely is this increasing demand for a US dollar, particularly from investors outside the United States. Now, what's interesting about this is that when you see this kind of rush for dollars, it usually signals that people are looking for a safe haven, and more importantly, but being need cash, like they need it now. You can almost think of the dollar in this situation as like a bunker during a siege. One of the ways we measure this demand is by looking at something called the 3-month cross-currency basis swap rates for the euro. Now, this is getting a little into the weeds, but basically, if the financial instrument that reflects the cost for non-US entities to get their hands on those US dollars. Recently, these rates were trading around -7%, which is a big jump from the over 12.5% they were at just a week earlier. To put in perspective, that's the most negative level we've seen since late 2023. Now, here's the thing, and it might seem a little counterintuitive, but a more negative number in this case actually means there's a higher demand for dollars. It's essentially saying that people are willing to pay a premium to get their hands on US currency. We're also keeping a close eye on those high-yield bond spreads. Sometimes these trades referred to as junk bond spreads, but essentially what they do is reflect the extra return that investors want, the demand for holding on to corporate debt that's considered riskier. So we're talking about bonds that had a credit rating below investment grade. Now, what's been happening is that these spreads have been creeping up. They've reached multi-month peaks. For instance, there's this index called the IQRX Crossover Index that tracks these 5-year European high-yield bonds, and just on Monday, it climbed about 420 basis points. To give you an idea of the scale of that move, it was the largest single-day jump since March of 2023, and more than that, it was the highest level we've seen since November of that same year. We're talking about an increase of something like 80 basis points compared to just a week earlier. And over in the United States, the ICE BOFA US High Yield Index actually finished the previous week at its lowest point since September. And it followed its biggest weekly drop since September 2022. So it's clear that there's a lot of nervousness around these riskier assets. All right, now let's shift gears a little bit and talk about global banks. These institutions are really the backbone of the global economy, right? The way they perform often gives us a good indication of the overall health of the economy and where things are headed. What we're seeing right now, though, is a pretty sharp decline in their stock prices. European and Japanese bank stocks have lost something like 20% of their value, and that was in just the last 3 trading days alone. And if you look specifically at Japanese banks, well, they tumbled by about 10% on Monday. U.S. banks didn't fare much better. Their stock prices fell by about 15% last week, which was their worst week since 2020. So these widespread and substantial drops in the banking sector are definitely something to keep an eye on. Another area where we're seeing increasing pressure is in the U.S. Treasury market. As you know, this is the biggest bond market in the world. And one of the ways that stress is showing up is in something called swap spreads. Now, I know this might sound a little technical, but bear with me. Basically, a swap spread captures the premium that you have to pay on the fixed side of an interest rate swap. These swaps are basically the tools that investors use to hedge themselves against changes in interest rates, specifically in relation to the yield that you get from U.S. Treasury bonds. So the U.S. 2-year swap spread, and this is just the difference between the 2-year swap rate and the 2-year Treasury yield, well, it briefly fell to almost -46 basis points on Monday. It did recover a bit to around -20 24 basis points, but that's still near its tightest levels since November. And these moves in swap spreads, they can give us some clues about how smoothly money is flowing to a financial system, and also about the perceived risk of lending to other institutions. Now, to help us understand all of this a bit better, I want to bring in the perspective of Nicholas Colas. He's the co-founder of Data Sugar Research. And he makes a really interesting point. He said that it's actually pretty rare for the VIX to close above that 40 mark. Historically, when it does, it's often a sign of a crisis that requires, and I'm quoting in here, an urgent policy response. And when you know, like the CBOE Volatility Index, that's the VIX, it was up again on Monday morning. This was after that big surge we saw on Friday. And if you remember, a lot of that was driven by those tariff concerns. Coles actually put out a note on Monday where he called Friday a genuine panic day. It makes sense, right? Stocks were falling on Friday, and the VIX closed at 45.31, which is more than 3 standard deviations above its long-term average of 19.5. And then on Monday morning, the VIX climbed even higher by about 7% to 48.54. That was on top of Friday's massive 50.9% increase. Now, Colas really emphasizes how unusual it is for the VIX to close above 40. He says it's only happened about 2.3% of the time. And he says the next level to watch is 50.7, which would be 4 standard deviations above the average. He also points out that the only other times since 1990 that we've seen the VIX at these kinds of levels were during the depths of the 2008 financial crisis, and then again during the 2020 pandemic crisis. Now, just to add to the sense of unease, the U.S. stock market continued to fall on Monday. This was after already recording its biggest weekly percentage drop since 2020 on Friday. Whois believes that we're likely to see stocks remain choppy and under pressure until there are some changes to the U.S.'s current trade and tariff policies. Shortly after the opening bell on Monday, the S&P 500 was down by 3.3%, the Dow Jones Industrial Average was down by 3.7%, and the Nasdaq Composite Index was down by 4.1%. And it's important to remember that the S&P 500 had already fallen by 6% on Friday, and that included the drop on Thursday, which was triggered by President Trump's announcement of new tariffs on April 2nd. Now, Colas argues that the reason the VIX is sitting above 40 right now is directly tied to, and I'm quoting him again here, U.S. government policies that are creating an investor confidence crisis akin to those of wars and major global economic dislocations. He believes that if we want to see volatility go down and stock prices stabilize, we need to see a shift in these policies. To illustrate this point, he actually took a look back at other times when a VIX closed above 40 and the policy responses that followed. He pointed out that in 1998, after the collapse of the hedge fund of long-term capital management, the Federal Reserve stepped in and orchestrated what he called a private sector bailout. After the September 11th attacks, the U.S. economy received support through what he termed incremental fiscal and monetary policy measures. Looking back at the lead up to the Second Iraq War, he noted that the bear market that ran from 2000 to 2002 actually ended in October 2002 when Congress approved military action against Iraq. And of course, during the 2008 global financial crisis, the government bailed out the U.S. banking system. In 2009, in response to the Great Recession, Congress passed the American Recovery and Reinvestment Act, and that's when stocks finally bottomed out in March 2009. A little later, the Greek debt crisis, which ran from 2010 to 2011, was ultimately resolved with the bailout package from the EU, and more recently, the 2020 COVID-19 crisis led to something like $5 trillion in U.S. fiscal stimulus, and the Fed flashed interest rates to zero. Colas emphasizes that the only times the VIX has closed higher than it did on that Friday were in 1998, that was for a single day. And there was a period in 2008-2009 where it happened for a day, then again in 2010-2011 for 3 days, then in 2020 for 22 days. He argues that in every single one of these cases, it took changes in government policies to bring that volatility on. So just to wrap things out, the VIX, Wall Street's famous fear gauge, has been climbing pretty steadily. It recently traded above 50, which is a jump of about 10%. What's really striking is that over the past 2 decades, there have only been 2 other periods when it closed above 50. The first was back in late 2008 and early 2009 during the worst of the global financial crisis. The second was in early 2020 during that coronavirus-fueled market sell-off. Now, the VIX has always watched closely whenever there's turbulence in the markets, and that's because it essentially tracks what investors expect in terms of stock market volatility over the next 30 days. It gives expectations from looking at the prices that investors are willing to pay for options on the S&P 500 index. And what usually happens is that when fear starts to rise in the market, investors turn to those options to protect their portfolios. And because of that, they're willing to pay more for them. And this is what causes the VIX to move in the opposite direction at the stock market, meaning that it tends to go up when the market goes down. For context, over the past 10 years, the VIX has averaged just a bit over 19. Though just to give you a sense of how high it can go, back in October 2008, it hit a record intraday high of 89.53. So this overview gives you a bit of a snapshot of the growing stress that we're seeing in global financial markets right now. It really highlights how things like uncertainties around tariffs and just the general mood of investors have a huge and rapid impact on how the market behaves. I hope you found this analysis interesting and informative. If you did, please hit that like button and subscribe to the channel for more deep dives into the world of finance. Thanks for joining me.